What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. Today, we're talking about a new tax court case that basically kind of goes down and hits all the key points we talk about so much on here when it comes to real estate professional status. So it's going to talk about what not to do with time logs, how the passive loss rules work, and and more importantly, why ignoring IRS mail is really kind of like ignoring the check engine light in your car. Everything will seem fine for a while, but eventually catch up to you. So the case in question is Mirch v. Commissioner. That's Tax Court Memo 2025-128. And it's centered around a couple, their attorneys. One's also a CPA with an LLM in taxation. They had a law practice, and they also owned some rental properties. And they tried to create the rental losses and treat them as non-passive through the real estate professional status in the short-term rental rules. So spoiler alert, the court was not impressed with the way they kept documentation. So first, let's start. Number one, the open your mail issue they had. So this started as a collection due process case. The IRS had filed a lien, calling it notice of federal tax lien. The year in question for this, I believe it was just only 2006. So the IRS issued this notice of deficiency for 2006, mailed it certified. The post office tried delivery and it came back unclaimed. So the taxpayers never had filed a tax court petition on time. Later, they tried to attack validity of the notice, and the court said, no, you already litigated the mailing issue before. We're not doing that again. So basically, you don't get to relitigate that level because you didn't like the way it ended. So big points here. You open any certified mail. It is stressful getting a notice or letters from the IRS, but ignoring it does not make it go away. Make sure your address is up to date. In this particular case, they had a street number typo on one of their returns. That wrong address ended up becoming their last known address for notice purposes with the IRS. And it's just kind of an example of why even the little data entry things matter so much when it comes to something like this. Now, going back to their tax return. So they ran a law firm. They reported on Schedule C. The big issue was their substantiation. They claimed several deductions. The IRS allowed some and disallowed others. And the court basically said, show me the business purpose and proof for these expenses. So they had some accounting records, bank statements, but they didn't connect the dots very well, or at least not well enough to substantiate the disallowed expenses. And, a key thing that pops up here, which I see often, not quite as much anymore, but used to, things like an ATM withdrawal receipt or just your bank statement, those aren't always enough for documentation. And that's especially true for things like travel. There's special substantiation rules under Section 274D when it comes to travel. If you're trying to write off travel, you need, in addition to showing that the expense was incurred, you need the who, what, where, when, and why kind of proof. So what was the purpose? I incurred this expense there and paid it from my business account. Therefore, it's business related. It's not going to win. So if you run a business or real estate investor, whatever it is, your record keeping generally has to answer these two questions. How much was it and what was the business purpose or what made it business related? If you can't answer at least those, then you're going to have a tough time dealing with an auditor. So they had bad record keeping, couldn't substantiate a lot of expenses. Now the big one is the real estate professional status trap. So generally, to qualify as a real estate professional under Section 469C7, you're going to need to show more than 50% of your personal service times in real property trades or businesses that you materially participate in, and at least 750 hours of your personal service time is in real property trades or businesses. So more than half your time in the 750 hours as a floor. So this case heavily focused on whether Mrs. Mirch qualified. So why her? It's because real estate professional status is tested per person, not per tax return. So only one spouse needs to qualify. So they were trying to qualify her in this case. but she has to actually meet the test. So the one important technical thing the court highlighted, material participation is determined for each rental property at each activity level, unless you make a formal aggregation election, the election to group. So for real estate professionals, that's under the -9 election in the regulations. You make this election to treat all rentals as one activity. They did not make that election. So each property stood alone. Now we're into the material participation. Remember, after you pass the 50% and 750-hour test, you still have to show material participation in your rentals in order to deduct your real estate losses. So in this case, they didn't make the grouping election. So now their material participation test applies to each individual property. So if you own multiple rentals, you need to make sure, after you show you qualify as a real estate professional, that you talk about this grouping election with your tax pro, because this is not automatic. It's not like, well, we reported everything on Schedule E, now they're grouped together. There is an explicit statement that needs to be attached to your return. Now, in reality, most tax software has a box you check for this, and it'll put the required language there for you. But in this case, they did not do that, which also caused issues for them. They also had a short-term rental. So their short-term rental, I see this, a lot of investors kind of take this approach. They go the short-term rental route and don't realize that just having the short-term rental doesn't automatically make it non-passive. You still need to hit that material participation and have the documentation to prove that. So these taxpayers had a renovation property operating as a vacation rental. So lots of stays, average rental period of 7 days or less. So it fell into the category where it may be treated as not as a rental activity for the passive loss regulations, but as non-passive potentially because it's a short-term rental. So they just needed to prove material participation. This vacation rental they had qualified based on stays, but they still needed to prove the material participation, and they failed to do that. And this time log issue for the taxpayer. So they had issues with the real estate professional status and their material participation in the underlying rentals, including the short-term rentals. So short-term rentals are looked at totally separate from your other rentals. When you're not going to group your short-term rentals with your long-term rentals if you're a real estate professional, so that you have two different buckets there if they messed that up. And they also messed up their time for the material participation in real estate professional. So for real estate professional, the spouse, Mrs. Mirch, had a log showing 944 hours of time, and it was put together after they were notified they were audited. So she had these very standardized time blocks. So 12 minutes to read an email, 12 minutes to send an email for every email, regardless of how long it was. For in between each stay, she had 7 hours of cleaning. It didn't matter if the tenant was there for a day or a month, and 8 hours of what they called site management for each day the property was rented because she was on call. Now, this specific, the 8 hours of site management and the cleaning, these were specific to the log for her short-term rental, but these issues popped up in her time logs for real estate professional status as well. And the court said that the email time, they accepted the email time as reasonable. That totaled about 7 hours, but they rejected the larger chunks, the 7 hours of cleaning, the 8 hours of site management, because they deducted significant costs for cleaning and maintenance, meaning they hired other people. So the court was basically said, well, how did it take you 7 hours to do the cleaning when you're paying someone else to do it? And they totally disallowed the on-call time because that's not the same as actually working. Your material participation hours, you have to be performing some type of work on the properties. So you don't get to claim 8 hours just because your phone was next to you. The courts refer to this as a post-event ballpark guesstimate. It doesn't work. It's specifically disallowed. So since the court didn't believe that she hit her 100 hours, she did not meet the material participation test for the short-term rental. They did not achieve material participation for the other rentals as well because they did not make the aggregation election to group their long-term rentals. So basically, the court's looking for specific activities that you did for material participation. So they want to know what you did. Is it realistic, the amount of time that you're claiming on your time logs? And is it defensible so it actually transpires into true events? If you're saying you spent 7 hours cleaning, but you also paid a cleaning service on the same day, they're going to see right through that. So if it looks like it was created to just hit a magic number and isn't realistic, it's going to be thrown out, your time log. Now, they also had another out-of-state rental, and this one was where their daughter attended college. It looks like it was Brown University. So they rented it to students. The daughter lived there rent-free. So this was their more long-term rental. They paid her to manage it. So paying their daughter to manage it matters here because they are trying to claim they materially participated more than anyone else. They said they're going for the 100 hours more than anyone else on this property, but they paid a property manager. In this case, it was their daughter. So they had a problem and they didn't aggregate to group this property with others. So they could not combine their time. And then one last kicker for these taxpayers is they had a net operating loss that they attempted to carry back. So they had an NOL in 2007, tried to carry that back to 2006, the year with all the issues. And the court basically said, you didn't prove that the NOL is larger than what the IRS allowed. The NOL needs to be absorbed in the earliest carryback year first, so that in this case, they needed to carry back to, I believe, 2005, and then anything left over would come up to 2006. So they messed up their NOL carryback election. Now, that, again, is just, it sounds like they're a little bit sloppy here and just didn't follow the rules. So they were disallowed that NOL carryback to 2006. And ultimately, the court ended up agreeing with the IRS. They sustained the lien on 2006 and threw out a bunch of deductions, treated all the real estate losses as passive. The short-term rental failed the material participation hour, so that was also considered passive. The NOL plan didn't work out the way they were hoping. So, everything really went against the taxpayers in this case. So the big message, I think, for real estate investors is basically, the tax rules around real estate can be really powerful, and there's a lot you can do there to improve your tax situation, but only if you legitimately qualify and also document like you expect to be audited. Your chances of an audit are pretty low. However, if you're using strategies that are generating substantial losses, your audit risk does go up. That does not mean at all that you're definitely going to be audited for taking a large deduction that's legitimate, but you should be prepared to just have your documentation in place as if you will. You don't want to be in a position where it comes up and now you're scrambling to pull things together because you didn't keep good records at the time. But that about does it for today's episode of the CPA Zone. If you enjoyed this episode, please subscribe and hit that like and subscribe button. And until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.